Hi, how's it going everyone? My name is Henk and welcome back to the channel. Now with the recent downturn in the stock market, I think this is a good time to remind ourselves of the story of Bob, the world's worst market timer, and how his story can help you navigate through these uncertain times. Bob is the world's worst market timer. He is always scared of putting money into the stock market unless he has seen the market has run up by a considerable amount. Now, he began his career in 1970 at age of 22. He was a pretty good worker and a pretty keen saver. Now, his plan was to save $2,000 per year in the 1970s and ramp that up by another $2,000 per year for each decade until he can retire at the age of 65. So in the 1970s, he's going to put in $2,000 per year. In the 80s, he's going to put in $4,000 per year. In the 90s, he's going to put in $6,000 per year, and then $8,000 per year afterwards, and so on, so on. So he started out saving $2,000 a year, and he saved for 3 years, and he saved up $6,000, and then he invested it in 1972. Bob was a very cautious investor, so he only wanted to put money into the market after he had seen it gone up. So he decided to put his money into the S&P 500 index in 1972 after it had gone up by a lot. However, what he did not plan was that the market would suddenly drop by almost 50% in 1973 and 1974. So what happened here was Bob put his money in the peak right before a crash. Now, because Bob was too scared to take his money out, he continued to hold on to his money into the market, and this turns out to be an extremely important decision later on. Over the next 10 years or so, Bob did not feel comfortable at all investing into the market, and he waited for another bull market run. So after 15 years of waiting, he had $46,000, and he decided to put it into the stock market again. So he put it into the stock market in 1987, and he invested in the same S&P 500 index fund. And once again, because he's the worst market timer in the world, he invested his money in right before a big crash. This time, the market crashed for around 30% right after Bob has bought this index fund. But again, Bob kept on holding onto the shares and did not sell out of his position. Bob did not feel comfortable putting his money into the market again for at least another 10 years until the tech bubble bull run started happening. And when it really ramped up till the end of 1999. By that time, he had another $68,000 of savings, so he wanted to invest that into the tech bubble. He bought into the market around December of 1999, and this was right before another big crash that saw the market go down by almost another 50%. And this lasted for around 2 to 3 years. But even after losing so much, he still decides to leave his money in the market. The last investment that Bob made was in October of 2007, where he invested $64,000 of his savings. And because Bob is the worst market timer in the world, he invested right before the great financial crisis, which saw the market drop by almost 50% again. Once again, Bob decides to leave his money in the market until he eventually retired at the end of 2013. Now, Bob was the worst market timer in the world, and his stock market purchases happen always right before a big market crash. Now, even with such terrible timing, is he still able to make money? All in all, he invested 4 times in the stock market, and the 4 times coincided with the 4 major crashes that happened within the last 40 years. Even though Bob is the worst market timer in the world, he still ended up being a millionaire with more than $1.1 million in his portfolio. The key here was that he allowed his investments to compound over the 40 period of time by never selling out of the market. And also using a very simple investment plan by investing in an index fund with a low fee. Now, this is obviously more of an extreme example with one man and one portfolio investing in one index fund. Now, in order to balance out your risk, it's possibly better to have your portfolio more diversified so that you're not only invested in company stocks. The other side of the story is that if Bob simply decides to dollar cost average into his portfolio, he would end up with more than $2 million in his account at the end. So this really brings me to something that I don't particularly understand what a lot of newer investors would say. So first of all, they would say that, oh, the stock market prices are too high, stocks are too expensive, I don't really want to buy anything. And then these days when the market starts falling, they keep on asking, oh, why is the market falling? Instead of seeing it as a potential opportunity to look for companies that are possibly on sale at a cheaper price. So when the prices are falling is actually a good thing, because for a good company or the broad market index, it would always eventually recover. And the market would always recover unless there's some really drastic situation happening, such as maybe one country declares war on another country, or we get an alien invasion of some sort. And if that was the situation, making money in the stock market would be least of your concerns.